Earl Henderson stocked shelves at a Walmart in Bentonville, Arkansas for 30 years. When he died in 2018, his brokerage statement showed $5.7 million. No, he didn't inherit the money. No, he didn't win the lottery. No, he wasn't a Walton, despite spending 3 decades inside their stores. He never made more than $42,000 a year. He drove the same beige Chevy pickup until the bumper rusted off. And yet, when his estate was settled, his daughter found a portfolio. That would have been the envy of most fund managers on Wall Street. How does a shelf stalker die with more money than the average orthopedic surgeon? In this video, you'll learn the 5 financial habits that turned Earl's modest paychecks into a multi-million-dollar fortune. And yes, there will be a few references to Warren Buffett along the way. Takeaway number 1, he bought what he sold. Walmart, like many American companies, offered employees a stock purchase plan. Earl could buy company stock at a 15% discount, automatically deducted from his paycheck. Most of his co-workers ignored it. They wanted the cash today, not paper IOUs. Earl signed up the first year he was eligible. He never opted out. From 1988 to 2018, he bought a small number of Walmart shares every 2 weeks. As Peter Lynch put it, invest in what you know. Earl knew Walmart. He saw the parking lot fill up every Saturday morning. He didn't need a CFA charter to figure out the company was selling more groceries each year. Walmart's stock returned roughly 11% annually, with dividends reinvested over those 30 years. A 15% discount on top of an 11% return turned $200 a paycheck into a portfolio worth millions. If you put $200 a paycheck into something compounding at 11% for 30 years, you end up with around $1.4 million. Concentration in a single name can destroy you. Ask anyone who worked at Enron. Charlie Munger said, "The first rule of compounding is to never interrupt it unnecessarily." Earl filled out the form once, in 1988, and never looked at it again. That single piece of paperwork was probably worth $1 million to him. Takeaway number 2, he never sold. From 1988 to 2018, Earl held his Walmart shares. Through 6 recessions, 2 market crashes, the dot-com bust, the 2008 financial crisis, and the 2020 drawdown that he sadly didn't live to see. Most of his co-workers panicked at least once. In 2009, when the market dropped 50%, the parking lot at the local credit union was full of people pulling money out of their 401ks. Earl was at his usual aisle restocking cereal. When his daughter asked him why he didn't sell during the crash, Earl reportedly said, "I still got paid that Friday. So Walmart's still selling stuff. Why would I sell my piece of it?" That sentence is worth more than most finance MBAs. Behaviorally, holding through fear is the single hardest thing in investing. Morgan Housel, in The Psychology of Money, writes, "More money has been lost preparing for crashes or anticipating corrections than has been lost in the crashes and corrections themselves." Earl never prepared for crashes. He just kept buying shelves of cereal and shelves of stock. The math of selling and getting back in is unforgiving. Missing just the 10 best trading days over a 30-year period cuts your return by more than half. And the 10 best days almost always cluster within 2 weeks of the 10 worst days. So if you sell during the panic, you nearly always miss the bounce. Buffett put it bluntly, "The stock market is a device for transferring money from the impatient to the patient." Earl was patient by accident almost. He didn't have a CNBC subscription. He didn't refresh his portfolio app every 15 minutes. He looked at his statement once a year, in February, when he did his taxes. That wasn't a strategy he learned in a book. It was a habit that emerged because he was busy stocking shelves. Here's the test for everyone else. Imagine the market drops 40% tomorrow morning. Will you sell? Most people answer no before the drop. Then sell at the bottom anyway. Earl's defense was structural. His statements arrived in the mail. He opened them once a year. He couldn't panic sell on a Tuesday afternoon. If he didn't even know what his portfolio was worth on a Tuesday afternoon, there is a real lesson there. The less often you check, the better you tend to do. Takeaway number 3. He spent like he made $30,000. Earl's lifetime peak salary was $42,000. He lived on roughly $28,000. The other $14,000 went into investments, on top of his automatic 401k contribution and his stock purchase deductions. Most of his co-workers with the same paycheck lived on $44,000. The extra $2,000 funded by credit cards. He bought one truck, used, in 1994. He drove it for 24 years. His house was 1,400 square feet on a half-acre, paid off in 18 years on a 30-year mortgage. He cooked at home 5 nights a week. He took one vacation a year, almost always to fish in Arkansas, never further than 200 miles from home. Earl wasn't suffering. By every account, he was content. His daughter remembers him laughing more often than complaining. The point isn't that you have to live like a monk. It's that the gap between your income and your spending is the only money you ever actually keep. Charlie Munger said, "I have known a great many people who got rich on a small income by simply living below their means. I have never known a single person who got rich on a high income by spending it all." Lifestyle inflation is the single biggest reason high earners stay broke. The doctor making $400,000 with 2 BMWs and a 6,000 square foot house often has less margin than Earl did. Earl didn't need a budgeting app. His budget was pay the bills, fill the freezer, send $100 to the church, and put the rest in the brokerage account. That's it. The lesson here isn't deprivation. It's that wealth is created in the gap between what you earn and what you spend. And that gap was Earl's true edge over almost everyone he ever worked with. Your salary is not your wealth. Your savings rate is. The math is uncomfortable, so most people refuse to look at it. A worker saving 50% of their income can retire in roughly 17 years, regardless of what that income is. A worker saving 5% will work for 66 years. Same income, same returns, same lifespan. The only difference is the gap. Earl's gap was about 33% of his pay. That's not extreme. It's just consistent. Takeaway number 4. He reinvested every dividend. Walmart pays a dividend. It always has since going public in 1972. By the time Earl retired, his Walmart shares were paying him dividends in the tens of thousands of dollars per year. Earl never spent a dollar of those dividends. He had his account set to automatic dividend reinvestment, often called DRIP. Every quarter, the cash that hit his account was used to buy more shares, fractional or whole, no matter the price. This is one of the least appreciated forces in investing. Roughly 40% of the S&P 500's long-term total return comes from reinvested dividends, not from share price appreciation. If you spend the dividends, you essentially cut your long-term return almost in half. Earl didn't spend them because he didn't need them. His paycheck covered his life. Anything coming back from his investments was free fuel for the compounding engine. As Albert Einstein supposedly said, though there is no record he actually did, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Earl earned it. The full math: $1,000 invested in Walmart in 1988 with dividends reinvested was worth roughly $145,000 in 2018. The same $1,000 without dividend reinvestment? Roughly $85,000. The difference is the dividends, doing their quiet work in the background. You can take this further. You don't have to own Walmart. The same DRIP setting exists at every major broker, on every dividend-paying stock or fund. Set it once, forget it. Let the compounding happen. There is one tax footnote. In a taxable account, dividends are taxed even if you reinvest them. Earl held his higher-yielding shares inside his retirement accounts whenever he could, which means he never paid a penny of tax on those dividends. There is one more nuance worth saying out loud. Reinvesting only works if the underlying business keeps earning. Reinvesting dividends from a dying company is just polishing the brass on a sinking ship. Earl was lucky in that respect. The business he was buying into kept selling more goods to more people every single year of his career. If you don't have that conviction in a single name, broad index funds solve the problem. Reinvest dividends from VOO or VTI, and you get the same compounding force spread across hundreds of businesses. Takeaway number 5. He didn't try to time anything. There is no record of Earl ever trying to predict a recession, a rate cut, a Fed pivot, or an election outcome. His daughter says he didn't subscribe to a single financial newsletter in his life. He read the local paper, the Bible, and occasionally a fishing magazine. He bought stock the same day, every 2 weeks, for 30 years. No matter what the market was doing. This is what's called dollar-cost averaging, and it is statistically superior to most active timing strategies, especially over multi-decade horizons. The reason is simple. When stocks are expensive, your fixed dollar amount buys fewer shares. When stocks are cheap, the same dollars buy more shares. Over time, you accumulate the most shares at the lowest prices, automatically, without ever having to predict anything. Studies show that the average retail investor earns roughly 3% less per year than the funds they invest in, because they buy after rallies and sell after crashes. Over 30 years, that 3% gap is the difference between 1 million and 2.4 million. Buffett wrote in a 2017 shareholder letter, "Performance comes, performance goes. Fees never falter. Replace fees with timing mistakes, and the same is true. They never falter either." Earl had a built-in defense against timing mistakes. He didn't have time. He worked 47 hours a week stocking pet food, paper towels, and frozen pizza. He didn't have the spare cognitive bandwidth to wonder whether the Fed would raise rates next quarter. By accident, his lack of free time made him a better investor than 99% of his coworkers, who watched cable financial news and made trades on their lunch break. Be careful what you optimize for. The viewer who is very engaged with markets often underperforms, the one who barely looks at them. Earl was barely looking. That was his advantage. The practical version for everyone else is automation. Set up a recurring automatic buy on the 1st of every month. Pick a low-cost diversified index fund if a single stock makes you nervous. Then close the app. Whatever date the market crashes on, your money will already be in motion before you have time to talk yourself out of it. Earl's edge wasn't intelligence. It was inattention combined with discipline. Those two are easier to install than people think because they don't require willpower. They require setup. So, what really separated Earl Henderson from his coworker, who retired with $400,000 instead of $5.7 million? 5 things, none of them complicated. He bought what he sold. He never sold. He spent like he earned $30,000. He reinvested every dividend. And he didn't try to time anything. None of these require a CFA, a Bloomberg terminal, or a 6-figure salary. They require behavior. As Morgan Housel writes, financial success is not a hard science. It's a soft skill. Earl had the soft skill. Most people don't. Now you do. If you want to go deeper on the psychology behind these habits, check out my summary of the psychology of money next. Cheers!